Hello everyone and welcome to this week's FX update. My name's Craig Erlam, Senior Market Analyst at OANDA. We'll start with a look at Euro Dollar. As always, probably going in the same order as we've seen in the previous videos. So for those of you who want to jump ahead, then feel free. Euro Dollar is starting to look a little bit toppy in the shorter term, or potentially a little bit toppy. We had this strong rally through the falling trend line, which you can see here, which went back to May of 2016. And once we popped through there, then we really did pick up some momentum here, breaking above the previous high at the same time through the 110 level, holding above the 110 level. And before we knew it, we were up at around just close to, we fell just shy of 113. 113, which we know is a notable resistance level. We've seen previously that we've run into resistance around these kind of levels during this period here. So when we ran out of momentum going into there, that didn't come as a huge surprise. What we've seen then is a bit of consolidation, a bit of a correction. And if we look at the 4-hour chart, I think it's a lot clearer on here how this stands. Now, the interesting thing here is we potentially got this kind of descending triangle now forming as well as a falling channel. So we've got a falling channel here where price is just consolidated within, but then you've got this clear level of support here. You can see on this occasion and this occasion, and then here we've got this clear level of support, prior resistance as well. So what this does is it gives you this series of lower highs and also a flat support. Now this descending triangle is typically bearish if we do see a break below, so that's something to keep an eye out for, because if we do, then what you're typically looking for here, or the potential for, and again this is all, as always, this is textbook stuff, you're looking at a move similar to the size of the open of the triangle, again projected lower. So in this case that would be around from what 112.70 through to 111.70-ish. So you're looking at potentially a 100 pip move to the downside. So a broader correction here down to say around this 110.70 kind of level, which would bring us back in line with this prior support. Now, a few things to just point out here. There's no guarantee that this is a descending triangle. Just because I've perceived it that way, it doesn't mean other people will have as well. And there's no reason to say it would be a sharp move. We could continue in this descending channel. I think ultimately what we need to, I think what's clear here is the momentum is still very much with the bull. So while we may see this kind of correction and it may come back towards these kind of 110.70s, I still think this looks quite bullish in the medium term. And I think this is a notable area of resistance, but I do think there is potential for us to break through here because the euro is currently so well supported, and I think the way the pair is behaving. Sorry, I'm just zooming out so I can stretch out these moving averages. The way that this is trading right now, this looks more like a consolidation phase to me rather than a reversal, and to reverse such a sharp move higher would also be quite unusual. So a couple of things just to keep an eye out for there. Now, as always with these chart patterns, there's no guarantee which way it's going to go. Just because it's shaping up for something, it could quite easily reverse. Next thing is cable. I'll just put this out on the daily chart here because we've actually had a really nice break in cable. Now this is something I've been alluding to now for the last few weeks really, because we had this sharp move higher in the pound. This was around the time that May announced that the Conservatives would be calling a snap election, which was seen as pound positive because it was seen as an opportunity for Theresa May to get a larger majority in Parliament, and it was seen as an opportunity to effectively strengthen her hand ahead of the Brexit negotiations and potentially allow her also to negotiate more on certain issues without having to rely on the support of the Brexiteers within her party, and maybe rely on some of the support of people who are looking for more of a softer Brexit. So this was seen as really beneficial for the pound, and as you can see here, the pound's really come off now around over the course of the last week, and that's come in line with the Labour Party actually considerably closing the gap in the polls on the Conservatives. Conservatives a week or two ago were around 20 points higher in the polls, and we had a YouGov poll last night from the Times which showed that the gap has actually fallen to 5 points. Now, we've seen in the past these polls aren't always reliable. We've seen in the past that sometimes they're outright wrong. But we have also seen in the past that markets do pay attention to them because there's very little else to actually go off of. Now, what we saw in the lead up to this was we saw this series of higher highs as we see this shallow rising channel. And during this period, momentum was falling out of the rally. We had the stochastic here, the MACD histogram, and the MACD moving averages, all showing momentum falling out of the move. And despite the fact that we broke through 130 on a few occasions, we were really struggling to hold above it. So the signs were here. And what we've actually had today on the back of these latest poll numbers is we've broken through 129. 129 is an important level. It's previously been a notable level of support, as we can see when I just go down to the 4-hour chart here. There's a few occasions here when you can see this has been support, but it's also now the bottom of that rising channel. So as soon as we broke through 129, we really did start to pick up some pace to the downside, and already we're back at 128. I do think we could potentially even go back towards the kind of 127.50s, and I think that's going to be a big test of support for this pair, and it's going to be a big test for the pound and sentiment in general for the pound. Euro sterling has continued to push higher. No surprise here. The boost that we've seen for the euro and the weakness that we've seen in the pound over the past 2 days has really propelled this higher. Now, what's interesting here is I've been talking about this for quite a while now, because we had this kind of potential head and shoulders forming. You can see that we had this 83 through 83.50 neckline. We had a couple of shoulders on this side and a couple of shoulders on the other side. That's not that unusual, and a nice head in the middle. Now, with the series of lower highs that we were seeing in that flat line at the bottom, it did look as if this was bearish, not necessarily falling in line with what people were seeing on the fundamental side, but this was looking typically bearish on the charts. But ultimately, should we have seen a break through the 86s, which would have taken us through the moving averages and the trend line, then that changes immediately. And that's exactly what we saw. We saw a breakthrough here, and all of a sudden we started to see this surging higher. So while we haven't got this falling trend line intact anymore, it is still worth noting that the head and shoulders, though, is still very much intact for now. The reason for this is because we haven't broken through this previous high, through these previous highs. It may not be following the trend line, but as it is, if we see a rotation to the downside here, we've still got a series of lower highs, and therefore momentum is very much with the bears. But also, as long as we don't see a break through these kind of through the shoulders, and I mean a significant break, you can see they're all similar sizes but different, but still different. But if we see a move back towards these kind of 90 levels, then that would suggest it's completely out. Should we see a rotation around these kind of shoulder levels, which is why I've marked 87.35, 87.90 here, because it's the most recent highs. Should we see a rotation down again, then that would suggest to me it's still intact. So that's the key levels now as far as I'm concerned with euro sterling. Aussie dollar's obviously been interesting over the last few days. The US dollar in particular, due to what we've seen from the Federal Reserve. We had the minutes released from the Federal Reserve on Wednesday, and taken to be quite dovish, just simply because and this is this candle here, I should stipulate, taken to be quite dovish just because the Fed are showing a little bit of concern about the fact that we are seeing still low inflation. We saw that weak first quarter of data, and what the Fed effectively said is we want to see signs that this is transitory, as we believe, before we start raising rates again. And yet the markets are still very much pricing in a rate hike in June, but again, we are just seeing that weakness in the dollar, because potentially this is affecting the longer term outlook. So when the Fed's speaking and the dollar is actually falling, you can see here on the CME Group Fed Watch tool that markets are still very much pricing in an 87.7% chance of a rate hike next month. You can go further down the line and you can see that December is they're less confident about a second rate hike in December at this moment, and they've been becoming less confident over the course of the last week or two, which is when we have seen continued dollar weakness. And again, beyond that as well, because they're talking about reducing the balance sheet, it's unlikely that they're going to reduce the balance sheet and raise interest rates at the same time. So this is being seen as dollar bearish. And we saw this kind of rally in the Aussie dollar on the back of that. Then yesterday, that kind of fell off a cliff once again. So it's not very technical, this part, because there's so much fundamental news. But we saw big sell-off in commodities yesterday, primarily in oil, which fell 5% on the back of the OPEC deal, which we'll touch on in a second when we come to dollar CAD, because it's far more oil centric. But it does affect all commodity currencies as well, as we've seen, and it did with the Australian dollar as well. Now that's produced an interesting setup. Firstly, I'd just like to say we did break through the 38.2, which is looking like a key level of interest for me. Beyond that, it was going to be the 50, and that 50 still remains intact if we do rotate higher. Then I'd be very keen on that 75 kind of 50 level. Got a few moving averages here. We've still got the series of lower highs, and it's the 50 fib. Now, a look at the 4-hour chart shows that I've got this interesting breakout though in the shorter term, because you can see that we got towards this 75.17 levels, and then we came back towards 74.42. From there we went back to 75.17, and then we came back through to 74.42 and broke lower. So this is a double top as far as I'm concerned. Anyway, this looks quite textbook actually, and what that means is because we've had the break at the front of the neckline, then that should suggest, again, this is going off textbooks, this is not my personal opinion or advice, but this suggests that we could potentially see a repeat of the move that we've already seen, but below the neckline again. So you've got the double top here, and what effectively the textbook says is if you see a break of the neckline, then you can take the size of that move and project it lower, and that's where you'd expect price to go. Again, that doesn't work every time, but that is certainly what the textbooks say. The one thing I would say is sometimes the neckline can act as resistance, and we can see it hit the neckline and rotate lower off of that. It doesn't always have to be that case, and if it does break above the neckline, it's important to know that the double top is very much in play. Now, in terms of working out where it's going to rotate lower off the back of that, there's a number of things you can use. Sometimes things like a Fibonacci can give you an idea of the kind of levels we're going to rotate off before we head lower, assuming of course it is, but there's other ways that you can determine that yourself as well, of course, as the most important thing, which is price action. But this would suggest that we're potentially going to see a move back towards these kind of 73.70s in the near term, back towards these kind of lower levels, and if we see a break of that previous support, then that could be quite bearish indeed for the Aussie dollar pair. But as I said, the real story in the commodity space at the moment has been the Canadian. It has been more influential for the Canadian dollar. Now, again, we saw the US dollar weakness on Wednesday. That's why we sold off back towards this 50 fib, where we did, interestingly, find support here. We're still in this longer term up channel in dollar Canadian. But we found support around these kind of 133.80s, and then we saw that sell off in Canadian dollar yesterday. This is the oil story. OPEC met yesterday to discuss potentially extending the output cut into either the end of the year, so a 6-month extension, or the end of March, which would be a 9-month extension. Now, for the first few hours, it was just OPEC members discussing this. After lunch, then non-OPEC members joined, so the likes of Russia joined the discussion, and then at the end of the day, they announced a 9-month extension at current levels. So that's a 1.8 million barrel cut in total between the two, which they believe will balance the market by the first quarter of next year. And by balance the market, what they mean is bring inventory levels down to their 5-year average, where they're currently well above. Now, I know what you're thinking. You're thinking, well, if they've agreed this cut and they think it's going to balance the market, why did the Canadian dollar and oil sell off? Why did oil fall 5%? Well, the simple reason for that is this move here. You can see the move into the meeting was very CAD bullish, and the reason it was CAD bullish is because oil rallied into the meeting. There'd been so much speculation over the course of the last few weeks. There'd been so many reports, so many comments coming from different OPEC officials that the market had priced it in. The market knew it was coming. What we were waiting for was confirmation, and when that confirmation was exactly what was priced in, then people start to lock in profits, because in this position, they were waiting to see if they could get that little bit more, which could have helped push price on from oil. But the fact that everything that they said was priced in, and potentially not quite enough, because the market people were talking about the potential for a deeper cut. So the fact that the announcement was the bare minimum of what the markets had priced in, then we saw that natural correction, and that's why we saw the weakness in the dollar yesterday, and that's why we're trading back above here. But interestingly, from a technical standpoint, we haven't broken above this candle here from Wednesday, so I'll be interested to see how this goes over the next couple of days, because I still think this is still very bullish, and around the 133.80s, we clearly saw that bullish move here. But there's so much fundamentals at play here. Sometimes we need markets to settle down and give us a clearer indication of where they're headed next, and I think this is one of those occasions. New Zealand dollar, US dollar, we're still range bound. We have been range bound now since the start of March. We had this floor which we briefly penetrated below earlier on this month, but we failed to hold. And interestingly then, That's when we broke through that descending trend line, and that's why we're moving. That's why we moved back up to these kind of 70, 50 levels. You can see with the strength at which we moved through that was clearly a very bullish move. So I can move these arrows because they are no longer effectively in play. We've run into resistance around the 70.50 to 71 kind of levels. Again, prior resistance. At the moment, there's no reason for me to believe, at least, that this is anything more than profit taking, just simply because that's a bullish break of that trend line that we've seen, and this would be a logical profit taking zone in the near term. We may see a correction back a little bit. We may even see a correction back towards these kind of 69.70s, 69.80s prior resistance, or even here 69.50s, again prior resistance. Fib levels on here may also offer some insight in terms of this as well, if they line up. So the 50 fib here lines up very nicely with these support, with these previous resistance, and same with the 38.2. But again, that's if we get back to those kinds of levels. We're already trading higher once again today. We may just burst through there back towards the kind of 71.50s here if this is looking particularly bullish. But at the moment, this is still range bound, and that's what it's been for some time. I'll wrap things up with the yen pairs, because I know this video is already a little bit long. The dollar yen is once again looking quite concerning. It seems that people are just not buying into what the Fed is saying right now. So while the Fed is expected to raise rates in June, it looks like further down the line, people are expecting a lower pace of rate hikes. And I think that's having a big impact on how the dollar is performing. Now, one thing I wanted to highlight from the last video is we broke through the Ichimoku cloud, and I'll say that is potentially a bullish sign, but what we needed was confirmation from the lagging line, and it looked as though that was potentially coming for a little bit. That was going to come around the 115s, which is where we had the top of the Ichimoku cloud, and we had this rotation in and off the bottom. And once we had that rotation off the bottom, then that kind of looked like we were potentially going to see then the move higher. And instead we broke back through, and when it broke back through here, price followed straight back through here. So we failed to get that confirmation, and now we're trading back in bearish territory below the cloud. And interestingly, we then, after this sell-off in the US dollar yen, we then had the consolidation here. You can see this kind of rising wedge, which we've broken through today. And where we've broken through is when we're failing to break through the Ichimoku cloud again. So this is quite a bearish sign for me, especially now that we've had this break lower once again. Key levels now for me are 110 and 110.50, 61.8 fib. Again, I've only drawn this fib on here speculatively because we're not in a trend right now. But if we are going to see a rotation high, then that could be an important level. But really, it's the 110 for me. It's the bottom of the Ichimoku cloud here. And should we see a rotation off there, then there's potential for a move higher and a break below. And I think that's looking quite bearish once again. And I think today's been helped by the fact that there is this kind of drop off in risk appetite, shall I say. We are seeing things like gold performing well today. The yen, of course, is performing well against all the other major currencies, particularly the pound. Sterling yen. Now, we thought we'd seen a big drop off in sterling dollar. Well, sterling yen has been far more extreme. Now, this is looking a little bit cluttered at the moment, so apologies for that, but I will go through everything and hopefully clear things up. You've got the two support lines here. This is prior zone of resistance. Added these on to see if they coincide with the fib levels here, and in the bottom case in particular, they do. So I think we've got a very important support zone here around 142 through 142.80, where we're currently trading within. At the very least, I wouldn't be surprised something similar to what we saw here off the 38.2, a little bit of consolidation. But if this is as bullish as it looked so far, then this could be a potential point where we do reverse higher. Alternatively, we may be looking at this kind of 61.8 level around the 140.50s, but that's another 200 points below where we are now. So that'd still suggest that we've got some significant downside. And another thing which makes that 140.50 so important is that's where the lagging line comes into play once again with the Ichimoku cloud. So I think that's worth certainly paying attention to. Should we see a rotation off these, and that would suggest that what we're seeing is nothing more than a correction. But given the political situation that we've got in the UK right now, and given how the polls are looking, I think it's worth just keeping an eye on that right now, because I think that's going to be an important driver for the pound. If the polls continue to shrink, the poll gap continues to shrink, then that could be quite worrying for the pound. like I say, this is not obviously personal political views. This is just how the markets are reacting. That's always how we should look at this. We should try and keep our views to one side to an extent. And if the markets are reacting one way to something, then that should be, at least from our perspective, that should be all that matters. Interesting again from Euro Yen, because again we've seen that propel higher. But we've run into a ceiling here around the 125.80s. Now, the interesting thing here is that's exactly where we ran into previously. So not only does that suggest that we are finding a little bit of a ceiling right now, of course, but it also throws up the potential for two outcomes. We saw this nice breakthrough here, and it's been confirmed by the lagging line. Now, one or two things could happen here. Either one, we come back towards these 122.50s and we complete the double top, a break of that 122.50 to the downside. Then all of a sudden that opens up a potentially quite substantial bearish move because of the size of the double top. It would be 125.80 through 122.50, so that's 330 pips, which would potentially suggest we're heading back towards these kind of 119 levels. So quite a bearish signal if we do see that materialize. The alternative is we rotate higher somewhere between the 124s and the 122.50s, and we have another move back towards the top. Well, that would actually open up the potential for a rising triangle, which would be potentially bullish because you'd have the series of rising highs and a flat ceiling, and typically that tends to favor the bulls in this case, at which point you could be looking at the 125.80, 126.50s as being potentially vulnerable to the upside, and a break of that, and we could be looking at these previous highs again around the 128.20s. Again, getting a little bit ahead of myself, but how this trades in between these two levels is now going to be, hopefully, gives a strong indication. But given that momentum is very much with the bulls, I'd be surprised if we do at this point see a break of this neckline. I think we'd need to see some significant risk aversion and or a very much a big downturn in the euro, which will convince the ECB to hold off till next year on tapering. So for me, this is looking quite bullish at the moment, and we're looking for confirmation through a reversal higher and a new higher low being made. That's all we've got time for this week, guys. Thank you very much for listening and joining. I hope you've all found that useful. Good luck over the next few days with your trading, or over the next week, should I say, until the next video. And I hope you all have a fantastic weekend. For more in-depth news and analysis, check out OANDA Market Pulse at marketpulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.